Good morning, everybody. If I'm clearly audible to all of you, can I just receive a couple of hands up so that I know? Yes. Thank you. Thank you so much for giving me that feedback that I'm audible well. So thank you so much, everybody. So today our topic is going to be valuation under FEMA. I believe that all of us present here are professionals, and either we are chartered accountants, cost accountants, CMA, registered valuers, and hence in all scenarios we receive the requirement for valuation under different laws. So let me give a quick introduction of myself. I am Nikisha. I am a chartered accountant and a registered valuer. I practice FEMA and valuations exclusively since last 15 years now. We've been dealing with various kinds of valuations, and today I have an opportunity, and thanks to IOB, that I have an opportunity to speak about both of my topics together, which is valuation and FEMA. FEMA, as a lot of you might be aware, that earlier FEMA came into existence since there is a foreign or a cross-border transaction in place. Prior to 1999, everything under FEMA used to be considered as a draconian law and would require a lot more compliances and lot more approvals in place. Now, after the FEMA Act 99 being in place, the FEMA is much more liberalized and they have less compliances. More importantly, if you are compliant enough, if you follow the guidelines and the regulations, you don't need to knock the doors of government or RBI to do 80 to 90% of your transactions. Yes, still there exists a couple of 10 to 15% of the transactions for which we need to still go to RBI or the government and get their approvals in place. So today our agenda is to identify and understand that under the FEMA law, Foreign Exchange Management Act or the Foreign Exchange Management Law, what are those transactions which as a consultant we have to keep in place, keep in mind that these are the few transactions for which under FEMA valuation requirements have been required or have been guided by the government or by the RBI officials. And what are those guidelines that needs to be followed? So first we will understand what are those scenarios or circumstances under which a foreign regulation will come into picture. Not only that, but we will also try to narrow down our scope and understand that what are those circumstances in which a valuation requirement has been prescribed. That is point number 2. Third, we will also try to understand that there are so many professionals. We have tax professionals, we have insolvency professionals, we have chartered accountants, cost accountant, merchant bankers, so many other professionals. So who are the ones which are recognized by FEMA and are allowed to provide valuation reports under FEMA, which will be accepted by the statutory authority? So this is going to be our brief discussion. We have 1 hour to discuss today. We will try to close our topic. I will close our topic within 40 to 45 minutes. So that last 15 minutes is what we can tip up on the Q&A part. Feel free to post your questions in the Q&A section. I will try my best to answer to each of it. So as I said, what is FEMA and the overview of FEMA? FEMA as a law is quite different from the other laws in terms of the tax professionals or the Companies Act. We usually see that the act is something which drives the entire operations, and we know, whatever we want to look up on any act, we will go back to Income Tax Act, open it up and see our answers. If we have any doubts regarding Companies Act, we will again go back to Companies Act, open the law and identify what needs to be done. But when it comes to FEMA Act would be, I think, less than 7 pages. And most of the time under FEMA, whatever are the rules and regulations or the provisions are governed by rules and regulations, which are regularly notified by RBI or the government. So whenever we want to identify and study FEMA, we cannot rely only on the act, but we will have to go back, identify the nature of the transaction, go to the relevant notification or the rules and regulations. There are also something called as master directions for particular transactions. Go to those master directions, And then under those master directions, we will find the rules which will be applicable to those particular transactions. When would FEMA come into picture? A very simple thumb rule: whenever there is any cross-border transaction or anything which involves foreign currency, FEMA की बत्ती जलनी चाहिए. We have to make sure, okay, इसमें FEMA का कुछ ना कुछ आ सकता है. Hence, we need to identify whether there is any regulation, whether there is any restrictions, whether there is any compliance reporting that has been brought under in each of those transactions needs to be looked at. Today, we are going to be having a couple of more transactions where FEMA is more closely directed. As I would say for example, let us take up a minute and if you guys have the option to put up messages in the chat box, put up a message on the chat box on what are those transactions which are commonly applicable with foreign exchanges. And if chat box is not available, we can also put it up, take the use of the Q&A. Can everybody who have come across those scenarios where we have foreign exchanges coming into picture? Correct. So whenever there is a export transaction, there is any import transaction, in those scenarios also FEMA is coming into picture because there is a foreign exchange transaction that happens in place that is being considered. But those are not the transactions which would require us to have any particular valuation in terms of valuation of shares, securities to be into picture. Our focus for the today's session is going to be more so on terms of scenarios where valuations of foreign share securities would come into picture. So here is the first key. Whenever there is a transaction which is called as foreign direct investment, which means there is any Indian company in which any foreign individual or a foreign company wants to come and invest in the Indian entity, or now Indian entity can mean Indian company, or it can also mean LLP. In both of these scenarios, the point would be that this will be called as foreign direct investment. Whenever there is a foreign direct investment, which means there is an inflow of money coming from a non-resident, and that is on a repatriable basis, and that money is coming in terms of a capital instrument. Now, capital instrument we mean is the equity instrument. It is for which we are going to be issuing the shares. Those are the transactions where FDI comes into picture and hence valuation comes into picture. Now, it is very important to understand that each and every word mentioned in this definition or in this transaction affects the understanding. Like, for example, we are saying if the fund is flowing into India from a non-resident. Now, there is a question. If the fund is flowing in India, if the fund is not flowing in India, which means the fund is lying in India in a non-resident ordinary account, which is called as the NRO account of the NRI. In that scenario, will that be called as an FDI? The answer is no. Since the transactions which flow through India or are on repatriable basis. Now, the meaning of the word repatriable is wherein you are allowed to take the money and the gain outside India after payment of due taxes are called as repatriable. Whereas if the fund is invested via the NRO account, which is the non-resident ordinary account, it becomes a non-repatriable, which is the funds or the gain, the principal investment amount or the gain over it, you cannot take it back outside India, and hence they are called as a non-repatriable. If the investment is on a non-repat basis, then there is no FDI flowing into India, in which circumstances there will be no need of a valuation certificate because those transactions would be considered as Indian transactions. But yes, as we said, any money flowing into India, the money is coming in India from a non-resident. Now, the non-resident means a non-resident individual or a foreign company. Both will be considered under the definition of non-resident for the FEMA purposes for the time. Second, it is coming on repatriable. As we said, there are two types of transactions coming in, which is repatriable and non-repatriable. If the fund is flowing through a non-repatriable base, again, the norms that we are discussing will not be applied. And the last part is, the money is being coming into Indian company for what? If it is coming for any of the capital instruments, which is equity or equity linked instruments, it will be considered as FDI. Here, FEMA goes one step further. Obviously, if it is coming in terms of loan, it will be called as external commercial borrowing or loan, and hence there is no valuation requirement because there is no FDI. But if given a question, what would be the scenario of a compulsory convertible preference share or a compulsory convertible debenture? FEMA specifically says that every compulsorily convertible instrument, which is a preference share or a debenture, are considered to be as equity shares, and hence it will be considered as FDI, and hence all the valuation requirement would be applicable. But if you are issuing an instrument which is optionally convertible debt or an optionally convertible preference share, in those circumstances, do not be considered as equity or deemed equity, and hence those circumstances you do not require to follow the FDI guidelines, no valuation requirements, but instead you will have to follow the ECB, the external commercial borrowing requirements, and compliances of those needs to be followed. So we discuss only on the first part, which is very, very critical to understand when, under what circumstances a valuation requirement will come into picture, and before that, whether it will be considered as FDI. Let's give me an example. One step further, I am not issuing an optionally convertible preference share. I am not issuing a compulsory convertible preference share, but I am issuing a redeemable preference share. The law is very, very clear that a redeemable preference share will not be considered as equity, and hence, though Companies Act may have the requirement of having valuation in place, FEMA will not have that requirement, and FEMA valuation will not be required. Second, we have to also understand that FEMA compliances and the valuation requirements are over and above the requirement of law of any other laws. Say, for example, there is a requirement of valuation for issue of shares by Companies Act, then that is the requirement of Companies Act for which a valuation report is required. If in the same scenario, the valuation or the company, the investor is a foreign company, then in that case, the requirement of valuation will be additional beyond the Companies Act, and even the valuation requirement under FEMA would come into picture. Now let's go to the next step and understand that who can give the valuation report under FEMA. As I said, that today the law has got a little bit of complicated, a little good for us, a little complicated for the client, is that there is a need of synchronization, because there are different professionals who have been identified as eligible to give the valuation report under different circumstances. Let me explain this with an example. Say, for example, an Indian company is receiving funds from a foreign entity for issue of shares, and those shares are issued at discounted cash flow method, which is they are issued at a premium. Now, in this scenario, there are three different acts which will come into picture. First, since the shares are going to be issued, Companies Act comes into picture, and Companies Act only recognizes a registered valuer for giving a valuation certificate. So, first of all, a company will be required to give a valuation certificate under the Companies Act, giving a fair value of the shares that is going to be issued. Now, secondly, since this company is being issued at premium, even the income tax will get up, and income tax will say, I also want to know at what value you have issued the shares, whether it is fair value or not. But income tax officials say, I don't know who is a registered valuer. In fact, they go ahead and say, I don't know who is a chartered accountant. For DCF, I do not trust their capability to give it. So they ahead and say, I will only need a valuation report from a merchant banker for income tax purpose. Then comes FEMA. So, okay, तो client ने दो valuation report ले लिए, एक Companies Act के लिए लिया RV से, registered valuer से, दूसरा income tax के अंडर लिया DCF के method follow करने के लिए from a merchant bank. Now FEMA खड़ा हुआ, हम क्यों रह जाए? Now, if the money is coming from a foreign entity, then in that scenario, FEMA says that I also will require a valuation report. You will have to justify to me also that your transaction that you have done it at fair value. But I also don't know RV. Well, I do not know registered value. But at least the good part is FEMA says I know merchant banker, a SEBI registered category 1 merchant banker. I also know a chartered accountant, and I will also accept a cost account. I have seen that in lot of scenarios, what if a chartered accountant who is also a registered valuer, you can issue a combined report as a CA and RV, which can be used for FEMA purposes and it can also be used for Companies Act purposes. But if we assume for the time being that it's a cost accountant who is doing this assignment, we will see that there is an RV who is giving report for Companies Act. There is a merchant banker who is giving report for DCF for Income Tax Act. And then there will be a third valuer who will be giving the report for FEMA purposes. But yes, today there are 3 professionals whom the FEMA law is accepting or considering eligible to issue the valuation report, with a chartered accountant, a merchant banker, and a cost accountant. Now let's move further and understand what will be the methodology that needs to be followed while doing the valuation of the Indian entity. If it's a listed entity, obviously the price that will be worked out will be as per the SEBI guidelines. If it's an unlisted entity, RBI says you can follow any internationally accepted pricing methodology. There is no specific methodology. I believe at least a decade ago, FEMA had specifically used DCF as a methodology to be followed while doing the valuation. But since a decade now, that provisions have been changed. Now what they follow is only an internationally accepted pricing method, and you can use NAV or DCF or a combination as an internationally accepted method, which is being accepted by the RBI officials and for that matter for the AD bankers too, while when we submit their reports, when we submit our reports with them. Now here is a very, very important, after we have known that what is the methodology that needs to be followed, it is very, very important to understand that there is a pricing guideline which has been prescribed under FEMA, at which the value, not for the valuation will be done as per the methodology, but the transaction can be done at what value, that needs to be determined. So usually when we say there is an issue of shares by an Indian company, if the Indian company is issuing shares to a foreign person, India बहुत simple बोलता है, मेरी जो fair value है, say for example 10 rupees is my fair value, it says आप बाहर बेच रहे हो तो महंगा बेचो क्योंकि मुझे foreign currency मिलना चाहिए. So your price at which you're going to be selling your shares to the foreign entity has to be higher than the fair value. Secondly, it is also very important now that the valuation report, earlier it used to be that a valuation report of a 6-month-old was accepted by the authorized dealer banks, who are the representatives of RBI, with whom we have to now do our major filings. But recently we have seen that AD bankers are not accepting the report which is older than 90 days when it comes to FDI, or 3 months older valuation report when it comes to even transfer of shares. So we have to be very careful on those fronts, that the moment your valuation report, the valuation certificate date and the transaction date, the gap between the two should not be older than 3 months. We move forward and now go deeper in understanding that FDI may, one, we said there is an issue of shares, and we very clearly said that when you are issuing the share, you will have money coming into the account. Once you have the money coming into the account, and before you want to issue the shares, you need to have a valuation certificate in place, and the value would be determined. The price at which the transaction, the shares will be issued, has to be higher than the price of the fair value of the company. Now we move forward that, okay, paisa to aa gaya, FDI is in place. Now say for example that individual want to transfer the share. Okay, now I want to transfer the shares, then am I allowed to? Yes. If you have invested the shares on repatriable basis, you are allowed to transfer the shares outside India. Now there will be question that boss transfer किसको करे? तो बोल रहे हैं कि दोनों को करो. आपको अगर कोई resident बंदा मिल जा रहा है who is residing in India, and make sure here when we're talking about resident, the definition of person resident in India is different under FEMA, is different from the definition of person resident in India as per Income Tax Act. But the residential status definition is different. So whenever we are doing any transaction relevant to FEMA, we have to go by the residential definition as per FEMA. So now the question is that, okay, a resident, say for example, I have bought the shares of a foreign company, or sorry, a foreign individual has bought the shares of the Indian company. Now he wants to transfer the shares. He has an option. Either he can choose to transfer the shares to another non-resident who is outside India, or he can choose to transfer the shares to any other resident who is reliable in. So a non-resident who has been issued the shares can sell the shares to a resident or he can sell the shares to another non-resident. RBI बोलता है तुम बाहर का non-resident हो, तुमने शेयर खरीद लिया, first time तुमने valuation कर लिया. Now you want to sell the shares to another non-resident who is again outside India. There is no compliances that you need to do, no valuation requirement. आप फुकट में दे दो मेरे को कोई फर्क नहीं पड़ता है because there is no money that is going to come to you. But when it comes to, and I'm talking restricting my discussion around FEMA, I'm not talking what income tax might come up and say, but this is what the FEMA law says. Now, if you're selling the shares, from a resident is selling the shares to a non-resident, say for example, I am owning the shares of my Indian company, and instead of issuing new shares, I want to transfer some portion of my shares to another non-resident, which is still called as an FPI, or some non-resident is already holding the shares and they want to transfer the shares to a resident in India. In both of these circumstances, it will be called as transfer of shares, and a valuation requirement and the reporting requirement will come into picture, which is where, again, as I said, who can give a valuation certificate? That remains true throughout the FEMA law. All these three people are allowed to do the valuation certificate. There is no restriction further on those lines. Valuation methodology also remains the same. If it is listed entity, you will follow the pricing SEBI regulations, SEBI guidelines. Unlisted, you will go ahead and do the internationally accepted pricing methodology. Pricing guidelines mein ek fark hai, though the fundamental remains the same. The fundamental is India ko nuksan nahi hona chahiye. So for example, if we are selling, a resident is selling to the non-resident, then they say महंगा बेचो, जो fair value है उससे ऊपर में बेचो. And if a non-resident is selling and an Indian person is buying, तो Indian बंदे को बोला जाता है सस्ते में खरीदो, जो भी fair value है उससे कम में खरीदो, उससे ऊपर आप नहीं दे सकते. So this is the pricing guideline in which the transaction happens. Usually the client wants to know what is the fair value and what is their pricing negotiated prices, and they want to see that they are fitting in within the pricing guidelines or not. And hence, as a valuer, we should not only know what methodology is to be followed, but we should also have to know what is the pricing guidelines talking about in each of the transactions, so that accordingly we can help them structure the transactions if required. Now a little bit more understanding on the FCTRS filing, because whenever there is an issue of shares or transfer of shares, in both of the circumstances, if it is an issue of shares, we will require to file form FCGPR. If it is transfer of shares, form FCTRS needs to be filed online. And in both of these circumstances, our valuation certificate is uploaded via the portal, which has been approved or reviewed by the AD banker and approved by the RBI, and the transaction is completed. And hence it is very important that we make sure our valuation certificate or the report meets up to the guidelines which has been prescribed. So unlike the other act, wherein, at times valuation certificate is taken as a safety purpose and may not be used immediately, under the FEMA Act, each time the valuation certificate or the valuation report is uploaded with the form, and every time the AD banker will review, check what is the value that has been prescribed by the valuer and what is the value at which the transaction is happening. That is viewed every time, and hence it is also more important that our transactions or our valuation certificates are in place as per the standards. Now, this is again a scenario wherein there is a transfer of shares, but here we are saying the transfer of shares has happened from a non-resident to resident. The scenario does not change, as I mentioned. I only said that there will be difference in the pricing structure, the pricing guidelines, क्योंकि अब non-resident बेच रहा है, resident खरीद रहा है, इंडिया बोलेगी मेरे को तो सस्ता चाहिए, जो भी fair value है उससे कम में आप ट्रांजैक्शन करोगे, उससे ऊपर में अगर आप ट्रांजैक्शन करोगे तो हम अप्रूव नहीं करेंगे. Now, since we said, we specifically talked about two transactions wherein we said that the valuation was required. Resident to non-resident, R to NR, or non-resident to resident, NR to R. But in circumstances when there are two non-residents who are transferring the shares, in that scenario, there will be no requirement for valuation or pricing guidelines, because there is no foreign currency that is coming into picture. And a foreigner X is selling to a foreigner Y. पैसा उन दोनों को मिल गया, the paisa did not route into India, and hence as per FEMA there is no valuation requirement, there is no reporting requirement. Similarly, if there is two residents who are selling the shares between each other and there is no foreign currency involved, again in those scenarios FEMA will not come into picture. Though, say for example, there is a company, a private limited company which has one of the foreign FDI coming into picture, one of the foreign investors, and there is another resident investor. If the selling of the shares is happening by a resident investor to any other resident person, still in such circumstances there will be no valuation required. So valuation requirement is not linked with company, whether the company has FDI or not, but the valuation requirement is linked with who is selling, who is buying, and whether the shares that are bought or sold are of the Indian. Further, if we go one step further, even if, as I said, there is no foreign currency, if the money is invested on non-repatriable basis, which is the money is not going to be going out of India, in non-repat basis also, again, FCTRS will not be requirement. If there is a sale which is happening on transfer or gift, in that scenario also there will not be a requirement for remittance or for the FCTRS filing. Here, move forward. Now we are going to a little bit of a bird's eye view on understanding, because after FDI we will move towards the next topic, next tranches or transactions for which the valuations will be required. So second, as we said, if it is, what is the nature? Issuance is by an Indian company. If it is listed, the price should not be anything which is less than, the price should not be less than the price as per SEBI. And if it is unlisted, price should not be less than the fair value which is worked out by not only CA but any valuer which is permitted as per FEMA. Which is, it is transfer from R to NR, price should not be the price less than the price as per SEBI guidelines. And in the other unlisted, it is as per the valuer's report. Transfer from NR to R, price should not be more than the price as per SEBI or the price that is worked out by the valuer. This is a little more understanding on the downstream investment, wherein also a valuation is required. Wherever there is an indirect investment, which is called as a downstream investment, lay for an example that there is a foreign company who has invested in an Indian company, and now that Indian company wants to further open up a step-down subsidiary, then that step-down subsidiary will be called as downstream investment, and there needs to be reporting which is done, which is called as Form DI. The first level Indian company making DI has to do the reporting, and the investee company makes an DI. There is further more step-down subsidiaries that is happening. Each of the circumstances, the reporting requirement is in place. This is an example to explain what is a downstream investment. Here, one more thing which is important from a FEMA perspective to be thought upon is that people say that now there is a foreign company which has invested in an Indian company. Indian companies further investing down, maybe it's 100% wholly owned subsidiary for the sake of example, who's investing downstream into another Indian company. The question will be, boss, down Indian company is investing in another Indian company, will FEMA laws come into picture? This is a common confusion that comes, but yes, since an Indian company is already having a foreign investor in place, it will attract FEMA. In fact, we had a query last week coming in wherein the FEMA does not allow investment in multi-brand retail trading. So the client was advised that was हमारी Indian company जो multi-brand retail trading करती है, उसमें directly foreign investment allowed नहीं है. Can we do one thing? Can we open another company which is say into any other trading activity in which the FDI will be permitted, and then step down? And then step-down subsidiaries will be coming into picture, and we will do the investment in the step-down subsidiary. The answer in such scenario is that no, it won't be permissible, because something which is not permissible directly is also not permissible indirectly, and hence such transaction does not work. Now we move to the second category of transactions where FDI or where a valuation is requirement. So that is called as overseas direct investment, which is completely opposite to what we discussed in FDI. Now there is an Indian company or an Indian entity, because an Indian company, Indian LLP and a registered partnership firm, all the entities are allowed to have an investment outside India, which will come as ODI. Now, when we say an investment outside India, obviously, first they have to contribute to the capital, which means they have equity share capital of that foreign entity. You cannot own only the loan section of it. You have to have equity capital in place. Again, you're allowed both the stuff. You can open up a new entity and have an ODI in place, or if there is an existing entity and now you want to acquire the shares of that existing entity, then in that scenario also, valuation requirement is it is still called as an ODI, and valuation will be required. Now here, if we go further, first of all, let's understand what is permitted. As we said, an Indian entity can have a wholly owned subsidiary outside India, or it can have a joint venture. It can have a joint venture with an existing partner there. Both are permissible. Secondly, you can contribute to the equity share capital of the foreign entity, or you can also contribute to the loan of the foreign entity. Both are permitted, provided you have some percentage of equity in place. Even a loan is permitted. You are allowed to have acquire shares by way of merger, demerger, swap. All of those are permitted. What is permitted to transfer is 400% of the net worth of the Indian entity. Say, for example, the net worth of Indian entity is 1 crore, then up to 4 crores, which is 400%, is allowed to be invested outside India. So these are a basic, first of all, understanding on the roots of the ODI. An Indian party, an Indian entity can have a JV or a WAS outside India. Second, an Indian individual, if people like you and me want to open up outside India, investment outside India, have a ODI, then you can have it under the liberalized remittance scheme, which is up to 250,000 USD. We people don't need to worry about our net worth. Indian government has given us a blanket permission of investment up to 250,000 US dollars is what you can invest outside India in ODI. In fact, last week I had also taken a lecture on explaining investment in foreign listed securities. We as an Indian individual also have the right to invest not as a business, but as an investment purpose. We can also invest in foreign listed securities. You want to buy the shares of Apple, Netflix, Twitter. It is permitted under the ODI route. We are also permitted to do businesses outside India, though with a few restrictions, and are allowed to acquire ESOPs or qualification shares if the host country wants such. Now let us understand what is the scenario in which a valuation certificate is required under the ODI provisions. So first of all, as I said, whenever there is an Indian resident who wants to acquire the shares of a foreign company or wants to open up a foreign entity, both of this scenario ODI mein valuation will be required. If you are opening up a new entity, first time, newly set up entity, so face value ही उसकी fair value है, which is understood by all the statutory authorities, and hence there is no requirement for a valuation certificate. But आपकी ही company है, 100% wholly owned subsidiary है, और आपने 1 लाख shares already subscribe करके, say for example $1 लाख आप भेज चुके हो, उसके ऊपर अब आपको वापस $1,000 भी भेजना है. Still in that scenario, a valuation certificate, knowing the value of that entity at that point in time when you use fresh share, valuation certificate will be required. Similarly, अगर आप कोई existing company है और वो existing company को आप acquire करना चाहते हो fully or partially, then in that scenario, you will need to do the valuation of that foreign entity, apply the internationally accepted pricing methodology, arrive at a price or valuation, a fair value, and you have to give the price or acquire the shares of those company, क्योंकि हम खरीदने वाले हैं, रेसिडेंट है, हम महंगा खरीदेंगे नहीं, उस fair value से कम में हमारा transaction का price होना चाहिए. So that is the provision under ODI. But the valuation of that foreign entity is a must. And the valuation of foreign entity can be done by a SEBI registered category 1 merchant banker, chartered accountant. Both are permitted to do the valuation of that foreign entity. I hope the laws are getting more and more clear on this front. As अगर हमने investment कर लिया, अब investment को बेचना भी तो पड़ेगा. So hence the provision of disinvestment in our joint venture or our wholly owned subsidiaries abroad. So yes, transfer by way of sale is permitted of that foreign entity. Transfer अगर आप वहां के listed stock exchange पे कर रहे हो वो भी permitted है, और आप private से अगर आप unlisted entity का private से selling करना चाहते हो वो भी permitted है. As I said, in both the scenario, very important point to be considered is that your value cannot be less than the fair value. Secondly, since it is the valuation of a foreign company, हम उधर के CPA, the certified public accountant of that country, cannot be forgotten, and hence the valuation, RBI will accept the valuation of an Indian chartered accountant, or it will also accept the valuation of a CPA outside India. These are a few other conditions that needs to be fulfilled before the disinvestment is in place. One, whatever is your dues, whatever, by name of dividend, technical know-how, royalty, commission, whatever name you have given, that dues needs to be paid. You have to bring those money back into India compulsory. So that is, there cannot be any outstanding dues before the disinvestment. You cannot do the disinvestment within 1 year, at least one financial year. अभी खोले वो कंपनी आउटसाइड इंडिया 1 साल तो दो. आरबीआई बोलता है गिव इट टाइम. यू कैन नॉट क्लोज द कंपनी बिफोर 365 days. आफ्टर 1 year you have done one whole filing of annual performance report and all. Post that only you can do the disinvestment transaction. But otherwise, yes, disinvestment is permitted. Again, very important here is in most of the scenarios of ODI, what we have seen is that there is a project profile report which RBI maintains for whatever transactions we have done, and 90% of the chances we have seen that the project profile as per RBI and as per the client is not matching. So if the client is planning for any disinvestment, it becomes important that need to make sure that the project profile as per RBI records and as our books are matching, so that whenever you go ahead and file the forms for disinvestment with the valuation report, you do not have hurdles further on. Because otherwise you will have to stop, get those reconciliation in place at that point in time, which usually delays the entire process. Now we will try to understand the applicability at a glance of each of the conditions, and the ones who are allowed and the ones whose requirement is a must. As we said, first, if it is an issue of shares, Companies Act will require a registered valuer's report to be in place. If it's an income tax, under Income Tax Act, for issue of shares, a merchant banker is required if DCF, if the shares are issued at premium. If the shares are issued at NAV, then in that case, chartered accountant can also issue the report. Under FEMA, a chartered accountant, merchant banker, cost accountant, all these three are allowed. Under the SEBI laws, obviously the registered valuer, merchant banker, all are allowed. Now when we go to the transfer of shares, Companies Act there is no requirement for having any valuation report in place as per Companies Act for transfer. As per Income Tax Act, yes, they want to know the tax calculation, and hence a merchant banker or a chartered accountant report is required under 11 UA to know the base value below which the share should not be transferred. Under FEMA, for transfer, you will again have merchant banker, cost accountant, and chartered accountant, and SEBI laws, we all of us are aware. So these are the few circumstances and scenarios under which a valuation report is required under FEMA. As we said, any transaction which is export-import transaction, FEMA is not having any valuation requirement or guidelines. Any external commercial borrowing transactions, again, FEMA is not required. There is no transaction wherein you need to do the valuation. More so, valuation is required under FDI, which is wherever there is a foreign direct investment coming in, or foreign, or the shares of Indian companies are transferred. Vis-a-vis, again, when there is an ODI, the overseas direct investment, these are the two major areas wherein a valuation report is a must for doing the transactions. We would request you guys, if you guys are interested, we run a WhatsApp group wherein we share the updates on the tax and the FEMA laws. In case you are interested, you can scan the QR code and join the link. If there is any trouble, we've given you the contact details below. You can connect it and request for the link too. We will further go ahead and see if there are any questions that needs to be answered with regards to any of the doubts under the valuation norms of the FEMA provisions. Feel free to have it. We have closed our session by 40 and we are open for the Q&A. There's a question whether the rule for valuation of immovable property outside India or in India. Yes, there is a separate provision with regards to valuation of immovable property outside India. Separate transactions or regulations that are following. There is no restriction in terms of valuation. Whatever value you are arriving at that value, you need to transfer your shares, pay due taxes, and you can go ahead and do your transactions. Mohit, I think we are through, and with the questions also.
Okay, ma'am. So you done with the session, ma'am, right, ma'am?
Yes, sir.
Okay, so all the members, if you have any query, please put a question in QA section. Ma'am, question from Ramachandra Murthy, sir. If a foreign company wants to take over an Indian company which is under CIRP, Corporate Insolvency Resolution Process, what are the other conditions that come into force?
Mohit, can you be a little louder?
Yeah, if a foreign company, I'm audible?
Okay. Sir Ramchandra ji, as we said that FEMA provisions will deal with only the valuation of those stuff. Whenever it comes to anything beyond the FEMA front of it, the provisions of those particular act needs to be looked into. I have no clue on the CIRP front, hence I will not be able to guide you on that. But FEMA does not speak of anything beyond whatever is the fair value pricing when we are going for the acquisition front. Which valuation standards should be followed for valuation under FEMA IVS? Yes, you can follow the international valuation standards, because there is no separate methodology or the standard that has been prescribed under the stuff.